Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?
Alright, so hi guys, welcome again to the channel. For those of you who are new, this is the Greedy Trader channel. Here we talk about everything market profile. So today I am going to give you a quick lesson, right? So consider this one a freebie. A quick lesson on the way to, in my opinion, intra-week trade. Right, I guess I needed to put a spin on this. Everyone talks about intraday trading, but really we're talking here about intra-week, right? Because your trade, the thing about trades is they can set up to be a day trade because you hit your profit target within the day, right? So it means that volatility was higher. So the trade itself didn't need to be a weekly trade because all of your profit target was hit in one trade, right? Or in one day, right? So quickly, what was a swing trade has now become an intraday trade, right? If you trade equities or you're in the stock market and you are, say, below the pattern day trade rule, right? And you don't have as much as $25,000 in your trading account, then you will fully understand what it means to have what you thought was going to be a swing trade become an intraday trade because you put targets or stops in. Right, so take this scenario. If you had a smaller stock trading account and you were still under PDT, then what tends to happen is you might take a trade, put your target in, and then Apple gets a special announcement, and then boom, your target's hit in one day. That technically becomes one day trade that is considered a pattern day trade, right? Which basically you can only do 3 of those in a week or in a 5-day trading period before your account essentially will be stopped from trading, right? So you tend to find that obviously what I'm about to tell you, equity traders, probably smaller equity traders anyway, have a little bit more respect for this. And it doesn't really matter if you traded options or equity options, that is, or you traded the cash stock, right? It really won't matter. If you're under PDT, you're under PDT, and that's just how it works in the US. So unless you're in a country where you're using, say for example, an offshore broker that can help you get around that, but a lot of those offshore brokers are not great, largely because they are exactly as stated, they're offshore brokers, right? So unless you're with one of those that can help you get around that, then you're often going to find that you're going to start taking the aspects of when what you thought was a swing trade becomes a day trade, you start really respecting the impact of that. Obviously, for some of us, we don't need to worry about that ultimately, but if you are in one of those situations, then it is what it is, right? So again, it's just something to be mindful of. And obviously, as we trade Forex or FX, there's no pattern day trade rule or futures. You can trade it in and out as much as you like. But again, I just thought it was a useful point to bring up because I'm talking about intra-week trading, because realistically, I'm considering the fact that you might really be taking a trade in a week, but then it becomes a day trade. So, to avoid conflating all this stuff and, saying that, well, I'm a day trader, I'm a swing trader. Really, anybody can be anybody. What most people will say is, oh, don't convert a day trade into a swing trade, for example. Right? Well, it really depends on your risk profiling. If you think the trade has more legs to run, then you can manage that trade, right? You can scale into your position, you can roll your stops. So a lot of ways to manage a trade as you sort of intraday trade, and that trade becomes a swing trade and so on. But some traders don't like the idea of holding inventory, and again, that also comes from the equity markets, because again, overnight gap risk is really high. So if you trade stocks or you trade options and you're holding an option going, well, with the options, if you're on the long side of the option, it's not too big a deal because you can only lose the premium, so you might not have that kind of gap risk, right? But again, let's say you had stops on that option and you weren't really considering the whole premium at risk, then you're probably going to end up losing everything you allocated on that trade. But I guess it's a lot better than if you're trading a cash stock and you had an overnight gap risk and the stock gaps down or gaps up. Maybe look at what happened to Nvidia as an example recently. I mean, that was a huge overnight gap risk there. I mean, market open, I think it was up 80% in pre-market, right? So again, stuff like this, traders just don't survive. Depending on the size of the position, it's just the end of the day. So that it was very possible you could have had that as a day trade. It was going into earnings, but if you had it as a day trade, then it would have been probably fine. So day trading, defining the two, I think, is a lot more important if you are a sort of stock or equity trader. Whilst the gap risk is quite low in, say, the well, I wouldn't say futures, but especially in the FX world, I mean, the gap risk is quite low. To some degree, it's also quite low in certain type of futures, depending on what you trade. But especially in CFD products, it's really low. So most of us don't really think about the gap risk. So we feel very comfortable sort of doing what potentially we call swing trading, right? But swing trading is only that thing that you tend to find that traders will do either on the long side of very reputable names, stock names, because obviously they're treating it more like a buy and hold position, to be fair, but you're not really going to want to be short on a swing trade. I mean, I think that's a recipe for disaster. But anyway, enough of that. I thought it was just a useful conversation to kind of sort of put out there in relation to intraday trading, swing trading, and, you know, sort of perhaps where the origins are. All right, so let's talk a little bit more about trading from a swing point of view. So what we got here, you're looking at a 4-hour profile, right? And this is just one way I'm going to show you. And guys, none of this is financial advice, but in any case, this is just one way I'm going to show you how you can trade. I'm going to give you one tool in your box, right? What I teach my students is a lot more stuff. And I think one of the ways we need to start looking at trading is, one, we need to be a little bit more diversified in ideas, because any good trader will tell you that trading is a lot to do with concepts, right? So we are all putting together a series of concepts you learn over time. So for example, we know concept number one is, we know that below significant lows there tends to be a lot of stops, right? Makes sense. If, for example, we can see for this move here, we can see a really big move to the downside, which means that they're going to be stops at this high, right? And we get some continuation, and it means they're going to be stops at this high. Now, of course, the stops here are going to be more accessible because they're closer to the close of this particular profile. And it means that people who are long on the close are going to have stops here. So the market generally moves looking for this kind of stop liquidity. So if that's the case, then we have to be conscious that whatever stop goes first should really add fuel to the fire, right? So again, if there are a lot of passive orders here to sell this market lower, then most traders want to be buyers into those orders, because there might not be enough demand at those highs, and again, we'll run out of buyers really quickly, and there will still be sell orders to be filled. So that means the market needs to go down and fetch more buyers, right? So that's kind of what we mean when we say that's kind of what we mean when we talk about ultimately things like gap risk, for example. I say gap risk. When we talk about things, for example, like sell pressure, right? That's exactly what we're referring to when we think also about stops as well, right? So that's concept number one, right? So we are aware that this is part of a series of concepts that we look at to kind of build our sort of trade idea, right? So that's concept number one. So again, just in the realm of giving examples, that's kind of one concept, right? The other concept that that's quite common, so we always talk about stops, so we kind of have an idea of where stops are going to be and so on. The other concepts we have is, say for example, a value trade. So the market tends to reference value a lot, and value is just basically where traders feel that prices are most efficient, and that's kind of, you know, either the market is cheap at a specific value or it's expensive. So for example, at value low the market is cheap, at value high it's expensive relative to that prior value, right? So that's a concept number two. So we also know that the market reference value, right? And if a market's, for example, if a market's going to be efficient, it means it needs to trade, for example, every point of control. So we essentially can't have what we call naked point of controls, which is exposed point of control. So that's another concept. So as a trader over time, you start to build these concepts into a trading idea, so you can see opportunities. And of course, the trading world has promoted the idea of setups for a long time. So it's like, I see the specific setup. So people think of the market in a by numbers terms, like, okay, this setup means this market is going to do X and Y. But really what we should be looking at is the overall concept that is playing out at that given point in time. Because remember, markets have forcing points, right? So you can't be in there forever, right? And you also have specific times you can be in there. So for example, if you are a longer term trader, you're going to trade over a different time horizon than, say, a shorter term trader. If you are in Europe, you're going to trade at a specific time as opposed to, say, someone who's in Asia. So there's certain opportunities that are not going to be open to you. So you have to look at the market in the context of the time frame that you're available to trade that market, right? And so again, when you think about that, it means that you need to be able to see your opportunity within your window, if within the window, i.e. that you trade. So let's take an example. Right, so this was the 6th of June, that was 2 days ago, right? So we can see this M bar here, so this profile, sorry, here. So what can we see when we look at this profile? So we can see that this market was going up, 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 up. This would have been early hours. Remember, these are 4-hour profile, guys, right? So because we're looking more about how we can do trades across an entire week, Monday to Friday. Right, and we're not so concerned about those trades going overnight because it's really down to when our target gets hit. Right, so we can see this bar here, the market is pushing down, right? So we've pushed down and clearly a lot of sell pressure, extended value. There was some building here, which means that there were late longs here and those guys have been touched out, right? So we broke the most significant low and now we're trading within this value. So we can see concept number one playing out, which is the value trade. So we've come in, entered new value, broke some key levels. Now we're trading close to what it would have been fair value, or more or less close to the point of control, which is the most occurring price. So as we broke into that, we can see that there were passive bids here. We're going to be paying attention to see if they're going to hold, but we're also aware that because of the 70% value rule, there's a higher chance that we're going to trade through those anyway, right? So all we need is just a little bit more volatility. So that's telling us that this market is heading for the downside, but let's say that we're looking at this market at 12. So this is the 12 noon profile, right? So we're looking at this market within that window, right? So, and that's, by the way, that's 10 a.m. because there's a 2-hour shift here, right? So that's 10 a.m. London. So we can see that the market here is building within that. So by the time we get to, well, 10, 11, 12, 1, 2. So by the time we get to 2 p.m., which is the start of the next profile, right? Then we've started to form a picture of what's happening. So we've pushed down, we've gone down, and what do we see here is a lot of bid stacking, right? So we've gone down, we've got a bit of a bulge on our profile that tells us that there was a lot of trading here and a lot of business was done here. So now we've identified some key references, right? And so this is some of the stuff I said to my students, right? So here we've identified some key reference points. So one, we can see that the market is too short and we've got a profile build up, so likely bid stacking. We've got a lower close, but that doesn't really mean anything, right? If we can start to retrace these bids, then it will tell us that there were buyers. We just have a bit of a price overhang, and that's perfectly normal with markets. So that's the first thing, right? Secondly, we can identify that there are likely to be stops above the profile's high, right? So that's concept number 2, right? So that's got nothing really to do with market profile, and we just know that. Secondly, if we're going to get any kind of bullish run, we need to see at least the buyers engulf prior value, right? Because what's happened is that we've taken the value reference low, closed the market above value in an excess point. So of course there's going to be probably a dip and we're going to play around, but if we can take out the high, it means that we've accessed stops. Now what we would want to see in scenarios like this is we go up, we hold at the high, maybe as opposed to spike it. And even if we spike it, we have to respect the fact that we've taken out the stops, we've spiked it. If the market doesn't go lower aggressively, then that means that it's pretty much holding for something else, right? It's probably going to move up. So again, we can see the evidence here that we spiked it. Now, where would this market go becomes the question, right? That's the eternal question. Now, what we tend to look at is on the spike, we want to identify, we want to be long, basically. It really, for me, it doesn't really matter where we're long. We could be long at the high, we could be long at the mid. We just need to be long before this market makes its next move higher, right? So we need to be in, right? And that's the thing about market. It doesn't give you much wiggle room. You need to be in, right? And so if we're long here, then we know that because there's a lot of sell pressure here, then our goal should be to trade as close to the fair value as possible, which will be for me the midpoint of this push lower. There was a significant sell volume here, so if sellers are going to take an interest, it would really come within this sort of price room where we saw the alpha stack, right? So if you want to be smart, you could probably put a sort of a, it's 124.40. Just grab this, pull it down. You would want to kind of aim it for the midpoint, right? That's kind of what I would look for, is the midpoint of the bar, right? So again, as we pushed higher, very quickly we were at that midpoint, right? So this is kind of a scalp trade. Now, if you look at the value of that trade on a standard lot, for example, right on the break, it's about $138, right? So we literally achieved that over the course of the overnight close into the early Asia kickoff, right? And that's kind of where we'd want to get out of this trade and walk away. Now, of course, managing the trade becomes tricky overnight because, again, as we went higher, again, you can see we hit that level, we based, right? So we had a build up very similar to here, and then we broke under, and then we took out the low. So again, if we're getting a build up here, it means there's a lot of sell, which means there's got a lot of liquidity here, and there's a lot of liquidity there, and that's in the form of stops, right? So we've got late buyers, and then we've got late sellers. So one of the things that the buyers would have done on seeing this particular move form, to protect themselves, they would have rolled their stops just below the high here, right? So you now have a bit of a tighter stop window, right? So if you haven't taken profits, you'll be sitting here with stops, maybe waiting for a retest of value high, and then we start to break lower. So those stops get triggered, we expect a cascade, and where do you think we're going to go next? Now, thinking about concepts, value trade concepts, we're going to go through value, which means that the next support should come roughly value low, right? But if we're on the short side, we want to be short and we want to look to take profits through value, right? So that's about $217 on a standard lot. So as you can see, you've got two trades already within the course of 2 days. You've got one going this way, 217, and another one breaking down, 317, right? So again, you can start to build that picture. Now what I'm going to do is just flash my PL on the screen for the trades that were done on the 7th of June, right? Just to give you an idea. So those were my own trades, right? But I'm using cable as an example. I didn't have a cable trade on there. Most of my trades came from crude oil and so on, but it's the same concept, right? So if I'm trading intra-week, that's what I'm doing. I'm trying to identify areas on slightly longer term time frames, but executing with the shorter time frame in mind, similar to an intraday trader, but with the willingness to push my trades if necessary into what we would call a swing position. So that's the basic concept. So we can take advantage of these short-term moves whilst all the while keeping the bigger picture in mind, right? So we can really deal with errors through trade management, or we can really deal with any kind of, you know, the market sort of changing its direction on you, right? So here's another example, right? So here again we can see huge push lower, build up, the market's holding, and then you can see that close above the high, right? So again, this gave you the idea that you can actually see that build up, and then you can see that close, and it's exactly the same thing that you want to do. Anyway guys, I hope you found this video useful. Again, hit the like and subscribe button so we can put more content like this out there to help you guys understand how we use market profile to deal with our intra-week trading. Till my next video guys, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?